And as we enter December, so begins the run into the end of what's been another eventful year. Although a lot could happen before the books close on 2017, including next week, when there'll be plenty for investors to digest, both top down and bottom up. From a macroeconomic perspective, we can look forward to the latest UK sentiment surveys or purchasing managers' indices from the construction and services industries on Monday the 4th and Tuesday the 5th respectively. Remember that a reading above 50 is generally indicative of future growth, one below 50 of a possible slowdown or even a recession. The last readings, as we can see here, were 50.8 for construction, where the trend's been lower for choice, and 55.6 for services, where the readings have been consistently robust. Now, the other big piece of macro news due next week is the latest non-farm payrolls, unemployment and wage growth numbers from America. They'll be released on Friday the 8th of December. To remind you, the US added a bumper 261,000 jobs in October, the best figure since July 2016. That took unemployment down to 4.1%, but wage growth still slowed to 2.4%. If wage growth does accelerate, that could prompt the US Federal Reserve to raise interest rates more quickly than expected. Although for what it's worth, the market's putting a 92% chance on a third rate hike this year when the central bank meets on the 13th of December. This chart shows the trajectory in US headline borrowing costs over the past decade, so yes, they're still very low by historic standards. Company-wise, it's a bit quieter, among the ranks of the FTSE 100 at least. Plumbers merchant Ferguson, Wolsey as was, is scheduled to release a trading update on Tuesday the 5th. Smiths Group hosts an analyst meeting on the 6th, and Primark owner Associated British Foods hosts its annual general meeting on the 8th. But for me, the most likely source of a fuss in the week ahead is the first half report from high-end house builder Berkeley that's due on Friday the 8th of December. For all of the worries about the UK economy, consumer confidence and Brexit, Berkeley's shares have done very well over the past year, as we can see here, rising by some 50%. Interestingly, that's tempted Chairman Tony Pidgley and Managing Director Rob Perrins and Finance Director Richard Stern and 3 other executive and non-executive directors to start selling some shares. So this trading update seems timely. The key numbers to watch from the first half numbers, well, they'll be as follows. First, the trend in reservations and whether there's been any stabilisation here. This will also be reflected in the forward order book, which came to £2.74 billion at the end of its last fiscal year. Second, look at the trend in pricing. In its last full financial year, Berkeley's average selling price was £675,000. This next graphic shows how Berkeley's average annual selling price has developed since the end of the Great Financial Crisis. Third, obviously look at earnings. For the full year, analysts are looking for a 3% increase in pre-tax profits to around £840 million. So I guess that rate of growth is a good benchmark for the first half. And finally, look at net asset value per share, which came to £15.56 at the full year stage. The last chart shows how the NAV, net asset value per share, has developed on an annual basis again since the Great Financial Crisis. Berkeley's shares do still trade at a big premium to that NAV, despite the questions over current trading. That's partly down to the fat backlog, but also the company's plans to return cash to shareholders at the rate of around £8 per share via dividends and share buybacks, spread evenly over the next 4 years. As a final point then, watch out for any update on the mix between dividends and buybacks. Thank you for watching, and I look forward to seeing you next time.